Welcome to this explainer. Today, we're diving straight into chapters 3 and 11 of our financial analysis material to unlock the true stories hidden within corporate financial statements. If you've ever looked at a balance sheet and thought, wow, that is just an intimidating wall of numbers, well, get ready. We're going to decode the narrative behind them and give you the power to truly understand corporate health.
Okay, let's dive right into this course syllabus. We'll start by looking at why we absolutely need to move beyond just the raw numbers, and then we'll open up the financial toolkit. After that, we'll examine market and debt measures, dive into common size and trend analysis, and finally wrap the whole thing up by prepping for the Anandam case study.
So, let's kick things off with part 1, Beyond the Raw Numbers, Why Ratios Matter.
The foundational concept here is that raw dollar amounts, they're practically useless when you're analyzing companies of vastly different sizes. I mean, think about it. How do we accurately compare a multi-billion-dollar giant to a local startup? If we just look at raw cash on the bank, the giant is going to win every single time. But are they actually operating more efficiently? Not necessarily. Scale completely distorts our perspective unless we equip ourselves with the right analytical lens.
And that lens is ratio analysis. By converting raw dollars into percentages and ratios, we instantly level the playing field. Say Company A has 30% of its total assets in liquid cash, and Company B also has 30%. We can compare their liquidity directly, even if Company A is literally 10 times the size of Company B. Ratios and percentages let us evaluate the actual health and efficiency of a business, totally regardless of its gross size. All right, moving on to part 2, the financial toolkit. Profitability, liquidity, and activity.
These three categories represent the core formulas every aspiring investor or business student really needs in their back pocket. First up are two massive profitability measures: return on investment, or ROI, and return on equity, ROE. ROI basically measures the profit generated from total available assets. ROE, on the other hand, zooms in on the stockholder's equity. It's asking, how much return is the company generating on the owner's money? And as a handy historical rule of thumb, an average ROE for most American manufacturing companies usually sits right in that sweet spot between 12 and 18%.
Next up, we have liquidity. This is simply a firm's ability to meet its current obligations. Creditors obsess over liquidity because it tells them if a company can actually pay its bills on time. We measure this using working capital, the current ratio, and the acid test ratio. Now, the acid test ratio, which you might also know as the quick ratio, is much stricter than the current ratio. Why? Because it completely excludes inventory from the current assets. Finding a buyer for your inventory takes time, making it way slower to convert to cash compared to, say, accounts receivable or just actual cash in the bank. Now, what's really interesting about this next concept is how we measure activity, starting with accounts receivable turnover. By taking net sales and dividing by the average accounts receivable, we find out exactly how fast a company collects cash from its credit customers. For instance, if a company's turnover is calculated at 12.8 times for the year, the real magic happens when you take 365 days and divide it by that 12.8. It reveals it takes this company about 28 days to actually collect its cash after making a sale.
And we use a very similar trick for inventory turnover. You divide the cost of goods sold by the average inventory. Say that gives us 5.2 times a year. Divide 365 by 5.2 and boom, you instantly see that inventory sits on the shelf for an average of about 68 days before selling. It's just a fantastic instant X-ray into how efficiently a company manages its stock.
Let's shift gears to part 3, Market and Debt Measures, Evaluating Risk and Potential.
This is where we start looking at how the outside world, specifically the stock market and lenders, views a company's risk profile. When looking at the stock market, the price-to-earnings, or PE ratio, is king. It compares a current stock price to its earnings per share. High-growth tech companies, like NVIDIA or early-days Tesla, often boast sky-high PE ratios because investors are essentially paying a premium for massive future growth expectations. Contrast that with mature legacy companies like Coca-Cola, which usually have lower, much more stabilized PE ratios, reflecting their steady, predictable earnings.
Now, for lenders, it is all about debt. The debt ratio reveals the exact percentage of a company's total assets funded by borrowing. If a company's debt ratio sits at 40%, that's a vital health check. Because if that number creeps too close to 100%, almost everything is financed by debt, and that is a massive bankruptcy risk if the company hits even a minor rough patch.
Another critical debt measure is the times interest earned ratio. By dividing earnings before interest and taxes by the interest expense, we prove exactly how many times over a company can afford its debt payments. If a calculation shows they can cover their interest 1.8 times over, they have a bit of breathing room. Generally speaking, the higher this number, the safer the company's debt position really is.
Okay, moving right along to part 4, common size and trends, seeing the big picture.
So now that we have our toolkit, we really need to scale back and look at multi-year macro trends. This is absolutely critical for the upcoming Anandam case study. The crucial first step is converting standard financial statements into common size statements. So the crucial point is, for an income statement, you divide every single item by net sales. For a balance sheet, divide every item by total assets. This simple conversion turns a messy, fluctuating pile of raw dollars into incredibly clean, comparable percentages.
Take Campbell's Soup Company's common size income statements over a 5-year period. Because every single number is presented as a percentage of net sales, spotting fluctuations becomes incredibly easy. You can instantly see, for instance, that their marketing and selling expenses hovered reliably between 10.4 and 11.8% of sales. It standardizes the data, so you can compare years side by side without getting distracted by overall revenue growth or decline.
Alongside common size statements, we use trend analysis, which is also known as horizontal analysis. This basically involves evaluating financial data moving from left to right across several years. You anchor your data to an oldest base year, making that base year 100%. Then, you express all subsequent years as a percentage of that base year. This brilliantly reveals the true velocity of a company's growth, or, its decline.
Visualizing this data exposes instant narratives. When you look at a trend graph comparing return on equity and return on investment for Campbell's Soup between 2013 and 2017, you can immediately see the narrative arc. There's a noticeable dip in ROE in 2016 before a sharp recovery in 2017, while ROI remains much more stable. Graphs like this tell a story so much faster than a table of raw numbers ever could. It really brings the whole financial picture into focus in a flash.
And graphing turnover versus margin brilliantly illustrates how combining different metrics gives you a truly holistic view. While the margin line might fluctuate up and down, the turnover could remain relatively flat. Graphing them together like this helps an analyst see exactly which operational lever, whether it's efficiency or pricing power, is actually driving the company's overall returns in any given year.
Finally, we arrive at part 5, prepping for the Anandam case. All right, this is the practical application phase. This is your exact roadmap for the final assignment. There are 3 major deliverables expected for the Anandam case. First, a cash flow analysis. Second, common size statements. And please note, this requires converting both the income statement and the balance sheet. Third, a trend, or horizontal analysis. You need to really map out that financial trajectory over time.
But listen, here's the absolutely crucial reminder I can give you. Analyze, don't just calculate. Raw math is not the goal here. The goal is to explain the why behind those numbers. If you spot a sudden spike in the marketing budget percentage on your common size statement, don't just report the number to us. Tell us what that actually implies about the company's strategy. Be an analyst, not just a human calculator.
Let's run through a rapid-fire list of professor-approved tips for your assignment. Use the discussion board if you need clarifications. Round your formulas to 2 decimal places. Show your work and your Excel formulas so your whole process is crystal clear. And remember, real companies use complex 10K reports. Campbell's Soup's was 60 pages long, which honestly is a highly recommended read if you're ever struggling with insomnia. But here is a massive pro tip to save your sanity. When dealing with those massive corporate 10K reports, jump straight to item 8. That is exactly where you're going to find the actual financial data.
The raw data is just the beginning. The numbers are telling a story. You now have the toolkit to look beyond the surface, to measure liquidity, profitability, and market potential. So as you apply these tools to your very first real-world investment analysis in the Anandam case, the only question left is, are you ready to read the story they're telling?